Imagine your family has a special savings account set aside for emergencies, job loss, major repairs, the unexpected. This account isn't for everyday spending or splurges. It's a safety net, quietly growing in the background, ready to catch you if life throws a curveball. It's the money you hope you never need, but you're grateful for when times get tough. Every month you might add a little more, knowing that this fund is what stands between your family and financial uncertainty. This account gives your family security, a cushion against crisis. It means you can sleep a little easier at night, knowing you're prepared for whatever comes your way. It's not just about money, it's about peace of mind and the confidence to face the future. Countries have something similar: foreign exchange reserves or forex reserves. These are vast pools of money held in different currencies like dollars, euros, or yen, and sometimes even in gold or other assets. They're managed by a nation's central bank and play a crucial role in the country's financial health. Held by a nation's central bank, these reserves aren't for daily spending. They're a shield against economic shocks. When global markets get turbulent or when unexpected events threaten the economy, these reserves act as a buffer, helping the country weather the storm. If a country's currency suddenly loses value, the central bank can use these reserves to stabilize it. By buying back its own currency or selling foreign assets, the bank can influence exchange rates and restore confidence in the nation's economy. Strong reserves signal economic strength and reliability to the world, much like a person with healthy savings is trusted by banks. Investors, trading partners, and other countries look at these reserves as a sign that a nation can meet its obligations and handle financial shocks. Recently, China and Israel have grown their reserves to record highs, showing their commitment to financial security. These countries have made deliberate choices, exporting more than they import, managing their currencies carefully, and building up their reserves over time. We'll explore how they did it, what drives reserves up or down, and why it matters, especially compared to countries like Indonesia, where reserves are falling. The reasons behind these trends are complex, involving trade balances, government policies, and global economic forces. By the end, you'll see why these national savings accounts are a cornerstone of economic stability. They're not just numbers on a balance sheet, they're a nation's insurance policy, protecting millions of lives and livelihoods. It's a story of planning, power, and protection in the global economy. Let's dive in. End of scene. China, the world's second-largest economy, has just reached a historic milestone, amassing a staggering $3.45 trillion in foreign exchange reserves. This figure isn't just a number. It's a symbol of China's growing influence and financial might on the world stage. Achieving this record didn't happen overnight. It's the result of decades of careful planning, economic reforms, and a relentless drive for growth. China's leaders have steered the country through waves of change, always with an eye on building a strong financial foundation. At the heart of this achievement is China's massive export industry. Factories across the country produce everything from electronics to clothing, shipping goods to every corner of the globe. These exports are a major engine driving the accumulation of foreign currency. When Chinese companies sell products abroad, they earn foreign currencies, primarily US dollars, but also euros, yen, and more. This steady inflow of foreign money is the lifeblood of China's reserves. The central bank collects these earnings, carefully managing and growing the reserves year after year. This process is methodical, ensuring that China always has a financial cushion for times of uncertainty. A significant portion of these reserves is invested in safe, reliable assets, most notably U.S. government bonds. These investments provide stability and generate returns, helping the reserves grow even further. When the value of these assets rises, so does the total worth of China's reserves, even if no new money is added. It's a smart way to maximize the impact of every dollar held. Recently, global asset prices have surged, giving China's reserves an extra boost. This upward trend has made the reserves even more formidable. In addition to bonds, China has been steadily increasing its gold holdings. Gold is seen as a safe haven, especially during times of global uncertainty or market volatility. By diversifying into gold and other currencies, China reduces its reliance on the US dollar and spreads risk across a broader range of assets. The rising price of gold has added even more value to China's reserves, making them stronger and more resilient against global shocks. Altogether, China's approach is a blend of robust exports, prudent investments, and strategic diversification. Each element reinforces the others, creating a powerful financial engine. The result is a financial shield unmatched by any other nation, a vast reserve that can weather storms and support China's ambitions. This new record is more than just a headline. It's a testament to China's growing power, careful economic management, and its determination to shape the future of global finance. End of scene. Israel, though much smaller than China, has also reached a record over $215 billion in reserves. For its size, that's remarkable, and it's no accident. Israel's booming tech sector, known as Silicon Wadi, drives foreign currency inflows as it exports high-value innovations worldwide. The Bank of Israel actively buys foreign currency to keep the shekel from getting too strong, supporting exporters and adding to reserves. Like China, Israel invests its reserves in safe assets which have risen in value. This combination, tech exports, currency management, and smart investing, has built a robust financial shield. For Israel, these reserves are about resilience in a volatile region and confidence for investors. It's a strategy of stability and strength. End of scene. So what exactly are foreign exchange reserves? You might have heard the term in the news, especially when countries face economic challenges or global uncertainty. But what do these reserves really mean? And why are they so important for a nation's economy? Foreign exchange reserves, often called forex reserves, are assets held by a country's central bank in various foreign currencies. The largest portion is usually in US dollars, but reserves also include euros, yen, pounds, and more recently, the Chinese yuan. These reserves aren't just piles of cash sitting in a vault. They're a mix of different financial assets. In addition to foreign currencies, reserves include gold, which has been valued for centuries as a reliable store of wealth. Central banks also hold special drawing rights, or SDRs, issued by the International Monetary Fund. SDRs act like a global reserve asset, representing a basket of major currencies and providing extra liquidity. Gold is especially important because it offers security and diversification. If the value of paper currencies drops due to inflation or market turmoil, gold can help protect a country's wealth and purchasing power. SDRs, meanwhile, give countries more flexibility. They allow central banks to access a blend of major currencies, making it easier to respond to international payments or emergencies without relying on just one currency. Managing these reserves is a careful balancing act. Central banks must keep them safe and easily accessible, but they also try to earn a modest return by investing in secure assets like government bonds. In times of crisis, like sudden currency drops, financial shocks, or when paying off international debts, these reserves become a crucial line of defense. They help stabilize the currency, reassure investors, and maintain trust in the country's financial system. In short, foreign exchange reserves are the bedrock of a nation's financial security, providing stability, confidence, and the ability to weather global storms. End of scene. Here's a twist. Reserves can grow or shrink even if a central bank doesn't buy or sell anything. Why? Because of currency fluctuations and asset price changes, known as revaluation gains or losses. Most reserves are reported in US dollars, but they include other currencies. If the dollar weakens, euros or yen in reserves are suddenly worth more in dollar terms. The same goes for assets like government bonds. If their market value rises, so do the reserves. Gold works the same way. When its price jumps, the value of gold reserves increases. So, record-high reserves often reflect both active buying and these passive gains from market movements. It's a numbers game, and timing matters. End of scene. Not every country is building reserves. Indonesia's have recently fallen to $135 billion. Why? First, the government used reserves to pay foreign debt. Normal, but it reduces the pile. Second, Indonesia's central bank spent dollars to support the rupiah when it came under pressure. These actions are necessary to maintain stability, but they drain reserves. Unlike China's steady trade surplus, Indonesia's trade balance is more volatile, making reserve management tougher. Still, Indonesia's reserves remain healthy, but the decline highlights the constant balancing act central banks face. It's a reminder, building reserves is hard and keeping them is even harder. End of scene. Why do big reserves matter so much? They send a powerful signal to investors. This country is stable and can meet its obligations. High reserves attract foreign investment, fueling growth and jobs. Low or falling reserves, on the other hand, can trigger panic. investors may pull out, causing a downward spiral. Large reserves act as a buffer, deterring crises and giving governments more freedom to make policy decisions. They ensure a country can pay for essential imports, even in tough times. In short, reserves are a nation's ultimate financial safety net and a foundation for confidence at home and abroad. End of scene. China and Israel both have record reserves, but their strategies differ. China's approach is about scale, massive exports, huge trade surpluses, and careful currency management. Its reserves are a tool for global influence and economic power, and China is diversifying away from the US dollar to reduce dependence. Israel's strategy is more defensive, focused on resilience in a volatile region. Its tech sector drives foreign currency inflows, and the central bank actively manages the shekel to protect exporters. For China, reserves are about shaping the world. For Israel, they're about securing its place in it. Both strategies work, reflecting each country's unique circumstances and ambitions. End of scene. The stories of China and Israel show the importance of strong reserves in an unpredictable world. These reserves are a nation's insurance policy, protection against crises, currency shocks, and global instability. China's export power and Israel's tech innovation have built their financial shields. Indonesia's experience reminds us that reserves can fall, and managing them is a constant challenge. Strong reserves build investor confidence, support policy independence, and ensure a country can weather storms. In the end, reserves are about sovereignty and security. They're a lesson in foresight and strategy for every nation. End of script.